Welcome back to the channel. A lot to unpack, a lot to talk about this week. Want to explore where things could be headed with the Bank of Canada, not only at their next meeting, but maybe in the few meetings to come as we continue to unpack all the data that's rolling out here, especially with Stats Canada's most recent report of 40,000 plus jobs basically being removed from the Canadian economy. Unemployment rate still holding steady at 6.9%, with many economists believing that that is going to increase very quickly over the next little while. And ultimately, what does it mean for fixed rate mortgages? What does it mean for your mortgage? Whether you're renewing your mortgage, maybe you're looking to buy, maybe you're looking to refinance, restructure, you got some debt, you have some situations that you need to take care of, and you're not sure where things are headed. Should I go fixed? Should I go variable? Ultimately, we'll have that conversation this week. Once again, welcome back to the channel. If you have not subscribed, we invite you to subscribe, hit that notification bell while you're down there, and more importantly, leave your thoughts, questions, and concerns in the comment section below. And don't forget to like and share the video. Let's get right into it. Ultimately, right now, there's a big conversation happening with fixed and variable rate mortgages, where the economy's headed, what's happening with the Bank of Canada. I mean, honestly, we're inundated with emails and calls from clients and messages on Instagram. So I thought I'd do this video to sort of isolate my position on what we see happening right now, at least from this perspective, at least from this desk. Now, ultimately, there are a lot of things you should be paying close attention to. Number one, we are seeing that the jobs numbers are not coming in as resilient as they once were. Obviously, with the unemployment rate staying at 6.9%, 40,000 plus jobs being removed. A lot of these jobs are obviously impacting younger Canadians. But one interesting component is something we've talked about on the channel is the construction jobs down 22,000 jobs. Obviously, around a big change, around 1.3% in those numbers, and that obviously is going to get a lot worse. Obviously, we've talked about how important construction jobs are to the Canadian economy, considering we don't really have much manufacturing. We don't really own much here in Canada. I mean, obviously, we are rich in natural resources, but construction seems to be the one thing that keeps the Canadian economy chugging along. And with unemployment ticking up, especially in that sector, talking to these trades, I mean, what is to come? I mean, just think about it. No building permits, developers aren't putting new projects. You're finishing the ones that are in the pipeline, obviously the ones that have already been permitted. So where are all these trades going to go and what's going to happen? So with that, obviously, there's a lot of projection that that's going to tick up very quickly over the next little while. Maybe not by September when the Bank of Canada meets again. I do think that the Bank of Canada, speaking of September and the next Bank of Canada announcement, I don't think the Bank of Canada will be cutting at that particular meeting unless, things change, the data changes. I mean, there's a lot of speculation also with the U.S. Fed that they might be cutting. So we have to keep that in mind. Ultimately, in the U.S., CPI inflation earlier this week came in pretty lackluster, status quo. So that does give the bank, the Fed, the U.S. Federal Reserve, the opportunity to maybe cut rates. I mean, that could be an opportunity for them. And on top of it, obviously, all the continued uncertainties with these tariffs. I mean, realistically, another extension with China, another 90-day extension. Will these tariffs come into play? Is it just a big joke? I mean, ultimately, right now, is it just something that we keep on hitting and resetting the clock on, or will they actually come in? And the reality is what's happening here in Canada. I mean, with so much uncertainty, obviously, whatever happens in the U.S., I mean, this is really the case. The U.S. market is the barometer for what happens with Canadian treasuries, where fixed rate mortgages are going, how our economy is going to perform, because we are so dependent on, trade with the U.S. and buying from the U.S. So this is super, super important because if we see, and ultimately talking about, think about this as we're moving through this conversation, what could be happening with the Bank of Canada, understanding two components as we're, sort of thinking about it. Bank of Canada, variable rate mortgages, prime lending, adjustable. Think about it that way. When you think about treasuries and bonds, you think about the economy, the debt being spent in the economy is very simply put, impacting fixed rate mortgages. So we have so many different push and pull factors happening right now. It's almost anybody's guess of where fixed rate mortgages could be headed. Now, it's probably a little bit easier to forecast where variable rate mortgages could be, but once again, with no sense of certainty, we don't know what's going to happen in the next little while. Because once again, the Bank of Canada, much like the U.S. Federal Reserve, have a mandate to address inflation. And if we see these tariffs come in, and if they come in, depending on how hard they come in, when they eventually come in, and ultimately as the Canadian tariffs on aluminum, steel, and so on continued, and autos continue to wreak havoc on the Canadian economy, how is that going to play out? Is the inflation numbers in Canada going to reside, or are we going to, see them increasing over the next little while? So we might see short-term pullback, but long-term, that means, hey, we might see things tick up, and if that ticks up, well, the bank can't learn a valuable lesson not too long ago, and I don't know if they're going to let that slide, if they're going to think it's transitory. So basically, if you're in a variable rate mortgage, you are playing a little bit with more of a risk or an appetite to risk to say, hey, maybe in the short run, we're going to see something change. Maybe not in September, October, November. Maybe we'll see a quarter, maybe we'll see a half. So maybe you're banking on that. So thinking at renewal time or getting into a mortgage, you may want to take a variable, shorter or long-term variable might be an ultimate play, but there's a lot of Canadians that just don't like that uncertainty, right? And ultimately, I always say to both clients, both of them looking at the option, saying, here's fixed, here's variable. If you can get a variable at a very good rate, and a very good rate is probably in and around the 4% mark, just slightly under or slightly over, depending on the product. Remember, if you're purchasing, that's an insured purchase with less than 20% down, must have a 3 in front of it. If you're basically purchasing with 30% or more down, you might see one with a very high 399, or you might see something 404, 414 in and around that territory, ultimately looking at your numbers. But if you can get a rate that is relatively close to that variable, you're taking the 3-year, you're looking at a 5-year variable, that's where the discounts are, most products, not saying all, but most of those discounts are there, weighing out those options, thinking about, hey, here I'm still cheaper taking the fixed rate here at 399 or 404 versus 414 or 424. And ultimately, I need that particular rate cut to happen. And more importantly, when you're thinking about that variable, not a lot of people talking about this, but it's what type of variable. I know a lot of people out there are really chasing the variable that's going to impact their payments. So if you are with a bank that their payments are a static variable rate mortgage, means your payment stays the same no matter what happens. Yes, more money goes towards principal and interest, but your payments do not change. So if you're looking for that, you have to understand the differences in those products. So there's really a lot to unpack. And ultimately, it's anybody's guess. If you're planning to buy, renew, if you're planning on restructure, refinancing your debt, ultimately speaking with a mortgage professional, whether it be someone here at InTouch Mortgage Solutions or someone that ultimately have that conversation, lay all the cards on the table, and make sure you're getting some options in regards to where you are. Obviously, when you're locking in that pre-approval, try to get a few different pre-approvals. That's very hard when you're walking into one bank. Key caveat here, I know there's a lot of people that come to us after they've gone bank to bank to bank. And, ultimately, we're talking about credit preservation here. I don't really want to get into pre-approvals, but it's super important. You walk into your bank, they pull a credit check. You walk across the street to the other one, they pull a credit check. I'll add, there's 2 credit checks on the system. So you do need to be cautious. When you're working with a broker, we can take it to the major banks. We can shop it around for you so you don't have to do that. It's one report, shopping around multiple lenders. Keep that in mind. And ultimately, what are your thoughts? What do you think is going to happen? Do you think the Bank of Canada is going to cut? You think the Bank of Canada is going to follow the U.S. Fed? What do you think is going to happen in September? Let us know your thoughts in the comments section below. But until next week, we'll see you again. Thanks again for stopping by.